welcome once again to Economy and World. In this section, we will take a deeper look at an event that marked a turning point in the economic relationship between the United States and Canada, and that revealed how far money had become a direct instrument of political and geostrategic pressure. What took place was not presented as a formal breakdown of agreements, nor as a visible escalation of traditional sanctions. It was perceived instead as a silent intervention in the most sensitive element of any modern economy: its access to the international financial system dominated by the United States. From that moment on, the economic relationship between both countries stopped relying solely on trade rules and began to depend in an explicit way on political decisions taken in Washington. The decision signed by the United States administration established a new framework of control over Canadian capital operating within the financial system of the United States, introducing restrictions and enhanced supervisory mechanisms for Canadian financial institutions that maintained links considered sensitive with countries defined as strategic adversaries by United States foreign policy. Although the legal text used broad and highly technical language, in practice the political message was clear from the very beginning. The main focus of the measure was directed at the relationship between Canada and China, and at the lack of a firmer decoupling of supply chains, investment flows, and industrial strategy from the Chinese environment. This reinterpretation of the bilateral relationship transformed Canada for the first time in decades into an actor subject to a level of financial scrutiny comparable to that historically applied to countries with which the United States had maintained openly tense relations. The most relevant aspect of this decision did not lie only in its political dimension. It was found in the specific mechanism that was put into motion. At the core of the measure was the creation of a financial firewall between a significant portion of the assets that major Canadian banks held inside the United States and their parent institutions in Canada. As a result, capital flows between both countries became subject to verification processes and to potential preventive freezes if direct or indirect connections were detected with Chinese entities or with supply chains associated with China. In a deeply interconnected global financial environment, where full traceability of every financial component is extremely complex, this measure turned a vast volume of routine operations into potential targets for freezing or delay. This regulatory shift generated a very high level of concern within the Canadian government itself. Not so much because of the immediate impact on specific sectors, but because of the structural risk it posed to the national banking system. The central concern was not a temporary decline in exports. It was the possibility that Canadian financial institutions would progressively lose their smooth access to United States funding markets, treasury instruments, and the main dollar clearing infrastructures. For an economy such as the Canadian economy, deeply integrated into the North American market, that loss of access was equivalent to introducing a permanent friction into the normal functioning of its productive system. This context became even more delicate when taking into account the real degree of integration between the two economies. For decades, trade, investment, and financing between the United States and Canada had functioned as if they were part of a single, extended economic space. With shared production chains, banks operating on both sides of the border, and companies structuring their financing with very little distinction between one market and the other. The decision taken in Washington altered that logic of integration and reintroduced a financial border that, until then, had barely existed. From that point on, the movement of capital stopped being a purely technical process and became a matter of political alignment. Markets reacted with a sharp correction in Canadian assets, especially in the national currency, which experienced a significant depreciation against the United States dollar. Unlike previous episodes, this decline was not linked to changes in commodity prices or to domestic macroeconomic conditions. It was driven by a sudden reassessment of the political and financial risk associated with Canada. For international investors, the main fear became the possibility that the country could be partially isolated from dollar liquidity circuits. This immediately transformed the perception of stability that had historically characterized the Canadian market. Behind this movement, a strategic interpretation quickly consolidated among major investment funds and international banks. If access to the United States financial system could be conditioned by unilateral political decisions, then country risk no longer depended exclusively on traditional economic indicators. It became directly linked to geopolitical alignment. From that moment on, legal and financial certainty was no longer guaranteed only by institutional strength. It became increasingly subordinated to the political relationship with Washington. This shift in perception was one of the factors that accelerated capital outflows from specific segments of the Canadian market. We now go to our colleague Mike.
Let us now understand the strategic origin of the conflict and the shift in policy in Ottawa, and to understand why this rupture took place at that specific moment and not at an earlier stage. It was necessary to closely examine the recent evolution of trade and industrial policy in Canada. In the months that preceded this turning point, the Canadian government had promoted a strategy of economic diversification aimed at reducing its structural dependence on the United States market. This strategy included a more visible rapprochement with China as a commercial, technological, and investment partner, especially in sectors considered priorities for the industrial transformation of the country. From the Canadian perspective, this shift was presented as a pragmatic policy designed to expand markets, attract foreign investment, and strengthen strategic sectors linked to the energy transition and advanced manufacturing. However, from the point of view of the United States administration, these same moves were interpreted as a direct challenge to its policy of containing China and to its attempt to close indirect channels for Chinese products and components to enter the North American market. One of the elements that most strongly influenced this interpretation was the role that Chinese companies began to play in industrial projects developed on Canadian territory, particularly in the electric vehicle battery sector, critical materials and technologies associated with decarbonization. In Washington, the idea became firmly established that these investments should not be viewed as traditional Canadian assets, but rather as production platforms with the potential to supply the United States market from an allied country, effectively bypassing the trade restrictions imposed directly on China. This perception was reinforced by the increase in Canadian exports that incorporated components of Chinese origin, which strengthened the argument that Canada was becoming a transit point for partially transformed products. From the logic of United States trade policy, this phenomenon was considered a risk to the effectiveness of its tariff regime and its strategic industrial controls. In the absence of a change of direction from Ottawa, the United States administration chose to escalate pressure from the commercial sphere to the financial sphere. The implicit message was that, if traditional instruments failed to reshape supply chains, control over capital and financing would become the most effective mechanism to force a strategic realignment. In this way, the conflict stopped focusing on the exchange of goods and moved directly into the financing of Canadian industry. This shift in approach had immediate consequences for the room for maneuver of the Canadian government. Stepping back from its strategy of industrial cooperation with China would have required reviewing contracts, canceling ongoing investments, and facing potential international litigation, in addition to damaging diplomatic relations with Beijing. Maintaining that same strategy, by contrast, meant accepting an increasingly conditioned relationship with the United States, with the permanent risk of further financial restrictions. The result was a scenario of constant pressure in which every decision involved significant economic and political costs. From that point on, the central dilemma for Canada was no longer how to diversify its international trade, but how to preserve access to the financial infrastructure of the United States without completely giving up its margin of strategic autonomy. This conflict, more than a single dispute, exposed a structural reality. In a global system dominated by the dollar and by the financial markets of the United States, the real capacity of a country to pursue an independent foreign policy is directly limited by its dependence on that system. Now let us look more closely at the banking system as the epicenter of the impact. because it was there that this new financial architecture began to reveal its deepest and most dangerous consequences for economic stability in Canada. Not because the system was technically insolvent, not because there had been a previous collapse in balance sheets, but because its business model had been built over decades on deep integration with the United States market. Major financial institutions in Canada had developed a massive operational presence south of the border, with branch networks, credit portfolios, investment platforms, and financial services that depended directly on continuous access to the dollar clearing system, wholesale funding markets, and a fluid relationship with the Treasury of the United States. When that access became conditioned by political and national security criteria, the risk was not only reputational, it became structural. The ability to move liquidity between subsidiaries, support positions, and refinance operations stopped being automatic and began to depend on external validation processes. In a highly leveraged financial system built on the speed of capital, any additional friction becomes a systemic problem. Market reactions were not limited to a brief correction in stock prices. They turned into a broad sell-off of Canadian bank shares, dragging down the entire financial market and sharply increasing risk premiums across the sector. This movement reflected a very specific concern. If Canadian institutions lost flexibility in moving capital between their operations in the United States and their parent companies, their operational efficiency, their capacity for expansion, and their competitiveness against banks based in the United States would be seriously damaged. This was not an immediate solvency problem. It was the gradual erosion of a model that had worked precisely because real financial barriers between the two countries had not existed. But the impact did not stop at markets or at the balance sheets of major institutions. The most sensitive consequence gradually spread into the domestic economy and directly affected ordinary citizens. The sustained depreciation of the Canadian currency immediately increased the cost of imports. In a country that depends heavily on intermediate goods, technological products, industrial machinery, and certain food items from abroad. This exchange rate pressure quickly passed through to final prices, generating a new inflationary impulse at a time when the Canadian economy was already showing signs of exhaustion after several years of cost-of-living pressures. This deterioration in purchasing power was particularly visible in large urban centers, where spending on housing, transportation, and basic goods absorbed an ever greater share of household income. The fall in the currency was not perceived as a technical phenomenon, but as a direct loss in living standards, as everyday products became more expensive after having remained relatively stable for years. Social discontent did not arise only from macroeconomic deterioration, but from a growing sense of vulnerability to decisions taken outside the country. At the same time, the central bank was pressured to adopt a more restrictive stance in order to contain the currency depreciation and prevent further deterioration in inflation expectations. This response, although necessary from the perspective of financial stability, had a direct impact on the mortgage market, which was already under strain after years of high prices and elevated household debt. Higher financing costs increased the risk of defaults, intensified pressure on homeowners facing refinancing, and deepened fears of a more severe correction in the housing market. Now, to understand how all of this economic impact ultimately moved directly into the political arena, my colleague Emily will continue with the internal political pressure and the fracture of consensus, a process that began to take shape. as financial consequences started to be felt in everyday life, in public debate, and in the stability of the Canadian government itself.
As the economic consequences began to become visible, the crisis stopped being exclusively financial and turned into a domestic political crisis. The Canadian government found itself under growing pressure, not only from the parliamentary opposition, but also from business sectors, provincial governments, and industrial organizations that demanded an immediate response to restore normality in the relationship with the United States. Public debate began to split between those who defended the need to preserve the strategic autonomy of the country and those who believed that any margin of independence became unsustainable if it meant being partially isolated from the financial system of the United States. The figure of the Prime Minister became progressively associated with the diversification strategy that had brought Canada closer to China, and that political link turned into a central element of the national debate. His opponents began to present the crisis not as the result of an inevitable confrontation between major powers, but as the product of a misreading of the real balance of power. The idea that Canada had overestimated its negotiating capacity in relation to Washington quickly took hold in public discussion. Calls for a change of direction intensified, including explicit demands to review investment agreements to limit the participation of Chinese capital in strategic sectors, and to reorient industrial policy toward a much closer alignment with the interests of the United States. However, the real feasibility of such an immediate shift was extremely limited. Dismantling ongoing industrial projects, renegotiating international contracts, and redesigning supply chains could not realistically be carried out in a matter of weeks, without generating additional economic costs. Political pressure became even more complex because of tensions between the federal government and several provinces, especially those with greater exposure to cross-border trade and to the energy industry. From these territories, the capacity of the central government to protect regional economic interests began to be openly questioned, and even proposals for direct negotiations with actors from the United States were raised in order to preserve specific commercial and financial flows. This debate exposed an internal fracture that, until that moment, had remained relatively contained within the Canadian institutional framework. Now, the industrial sector became one of the most affected by the new situation, not so much because of the existence of explicit prohibitions, but because of the disruption of the payment and financing system that sustained the daily functioning of North American production chains. For decades, Canadian industry had operated within an ecosystem deeply integrated with the one in the United States, in which components, parts, and services crossed the border several times before a final product was assembled. This model, based on financial trust and on the smooth flow of cross-border payments, became vulnerable once transfers began to face greater scrutiny. Canadian companies began to face payment delays, higher compliance requirements, and a significant increase in the administrative and financial costs associated with each international operation. In some cases, suppliers from the United States chose to reduce their exposure to the Canadian market in order to avoid regulatory risks, generating disruptions in the delivery of key inputs. The immediate consequence was a slowdown in production in certain manufacturing sectors, especially in those highly dependent on components imported from the United States. This environment created an increasingly clear incentive for the relocation of industrial activities to the territory of the United States. From the perspective of many companies, establishing or expanding operations south of the border became a way to eliminate the financial and regulatory risk associated with the new situation. The result was a growing fear of a gradual process of deindustrialization in certain Canadian regions, particularly in those whose competitiveness depended on their direct integration with the market of the United States. In addition, the technology sector was not left outside the scope of the new restrictions. Canadian companies with foreign capital participation, especially those linked to Asian investors, began to face difficulties in accessing certain technological services, data infrastructures, and computing platforms located in the United States. Although these limitations were not publicly presented as direct sanctions, in practice they functioned as a filter that affected the ability of Canadian startups to scale their operations in a highly competitive environment. This context accelerated a process of corporate relocation toward the United States, especially among emerging companies that depended on international financing and access to advanced technological infrastructures. The consequence was a growing fear of a loss of talent, of highly qualified human capital, and of innovative projects, weakening the aspirations of Canada to consolidate itself as a regional technology hub. At the same time, New frictions emerged in cross-border mobility. Additional controls on travelers and transport operators introduced significant delays at border crossings, affecting both tourism and logistics. In a system based on just-in-time deliveries, even small accumulated delays translated into visible disruptions in distribution and in the supply of certain products. Let us now look at the effect in the United States and the strategic calculation behind it. Although the dominant political discourse in the United States presented the measure as a necessary tool to protect national economic security, collateral impacts on companies from the United States with strong exposure to the Canadian market also became evident. Exports to Canada represented a relevant source of income for thousands of companies from the United States, and the combination of the depreciation of the Canadian currency, slower payments, and weaker demand began to affect their financial results. However, from the strategic perspective in Washington, these costs were considered acceptable in relation to the main objective of reconfiguring regional supply chains. The central calculation consisted of using financial power as an instrument of geo-economic discipline, sending a clear signal both to Canada and to other commercial partners. Integration into the market of the United States implied a deeper strategic alignment, especially in relation to China. In this way, the Canadian crisis acquired an exemplary dimension, becoming a visible case of the consequences of attempting to maintain an intermediate position between the two main poles of global economic power. This logic reinforced a broader trend toward the use of financial tools as a partial substitute for traditional diplomatic instruments. Access to markets, payment systems, and financial platforms stopped being an implicit right for partners and became a permanent negotiating lever. In this new environment, economic stability stopped depending only on domestic fundamentals and began to be conditioned by the position of each country within the new map of geopolitical alignments. The result of this second phase of the crisis was a progressive reconfiguration of business and investment expectations in Canada, marked by caution, the reassessment of projects, and the search for alternatives that would allow exposure to an increasingly politicized financial environment to be reduced. The dominant perception that began to take hold within the productive sector was that the problem did not lie only in a single decision, but in the establishment of a new structural framework for economic relations in North America. After everything that had unfolded on the financial, industrial, technological, and political fronts, what ultimately became clear was that this episode did not represent a temporary crisis or a simple phase of tension between two governments, but the consolidation of a new type of economic relationship based on the ability to control access to money liquidity and international financial infrastructure. Canada found itself trapped in an extremely uncomfortable position, not because its economy was weak in productive terms, nor because its banking system was poorly managed, but because its high level of dependence on the financial ecosystem of the United States severely limited its real margin of strategic autonomy. From that point on, the central question was no longer how to restore growth or stabilize the currency, but how to rebuild a relationship of financial trust once that trust had become subordinated to political and national security criteria. This episode left a lesson that goes far beyond the Canadian case, because it clearly showed that, in the world today, economic sovereignty does not depend only on having natural resources, industry, or talent, but on having stable, predictable, and politically secure access to the major financial centers that dominate the global system. When that access becomes a tool of pressure, all economic models based on interdependence are exposed. What is most significant is that this precedent was not limited to North America. From that moment on, other countries quietly began to reassess their own exposure to the financial system of the United States, their dependence on the dollar, and the fragility of their financing chains. The use of capital as an instrument of power shifted from being a theoretical threat to becoming an observable reality, and that transformation changed the way governments, companies, and investors evaluated political risk. Money stopped being neutral and became a direct part of competition between geopolitical blocs. In this new environment, economic stability could no longer be analyzed only through traditional indicators, because foreign policy, strategic alignments, and national security decisions began to directly influence currency values, the location of investment, and the survival of entire sectors. If you want to understand how major geopolitical shifts end up affecting your money, your investments, and your everyday economy, subscribe to Economy and World. Turn on notifications, leave a like if this analysis helped you better understand what was really happening behind the headlines, and share it with someone who still believes that international politics has nothing to do with their wallet. See you in the next video.